The broadcast is now starting. All attendees are in listen-only mode.
Thank you, everyone, for joining us today for Pristine Advisors webinar series, Putting Shareholders First. We have a great lineup of speakers for you today. And just a reminder, the event will be replayed, and the event can be found on our website under cefnetwork.com under the Events tab. That's where you'll find the replay. So today we have a wonderful lineup of speakers. Our moderator today will be Ken Fincher. A little bit about Ken. Ken is a Senior Vice President and Portfolio Manager at First Trust Advisors. Mr. Fincher joined First Trust Advisors in November of 2008 after spending the previous 3 years at Calamos Investments and 17 years at Nuveen Investments. His current responsibilities at First Trust include management of separately managed accounts that invest primarily in closed-end funds. Previously, his responsibilities at First Trust included the development of new product structures in the closed-end fund space. At Calamos, Mr. Fincher served as a product manager and client advocate for Calamos closed-end and open-end mutual funds. In this role, he worked closely with strategic alliance partners, as well as intermediary distributions, portfolio attribution, CRM, and marketing teams. While at Nuveen, he spearheaded the development of the dividend advantage structure that enabled Nuveen to raise significant new closed-end fund assets, as well as development of the first public disseminated closed-end fund index and the website etfconnect.com. Mr. Fincher has been named Outstanding Individual Contributor to the closed-end fund sector in 2005, 4, 5, 6, and 7 by financial analysts and his peers in the closed-end fund community. Our presenters today are going to be Jeremy Bannister, Director of Corporate Governance of City of London Investment Management. Jeremy is based in the U.S. office. He rejoined City of London in 2005. Jeremy worked at the Vanguard Group from 1985 to 2005 in the product development and portfolio review departments, becoming a principal in 1992. He originally joined City of London in 1998 in a client servicing role and returned to Vanguard later that year. He holds a JD from Widener University School of Law and a BA in Economics from the University of Pennsylvania. We also have with us today Phil Goldstein, co-founder and principal of Bulldog Investors. In 1992, after a 25-year as a civil engineer in New York City, Phil Goldstein co-founded what is now Bulldog Investors. With approximately $600 million under management, Bulldog Investors is a value-oriented group of private investment funds that invest primarily in closed-end funds, small-cap operating companies, special purpose acquisition companies, and special situations such as bankruptcy claims. Often employing activism to unlock the intrinsic value of investments, Bulldog has conducted approximately 40 proxy contests, and the firm's original fund has returned more than 12% per annum net to its investors since inception, with only one down year. Having served on a variety of boards of directors over the years, Mr. Goldstein is currently chairman of Imperial Holdings, Mexico Equity and Income Fund, and is director of Special Opportunities Fund and MVC Capital. We also have with us today Dan Lippincott of Corpus Investment Management. Dan joined Corpus Investment Management in 2003. As a senior tax-sensitive portfolio manager, his product has earned PSN Top Gun status with 6 stars. Dan has been featured in various publications, including the Wall Street Journal, Rochester Business Journal, and the Hertzfeld Guide to Closed-End Funds. He holds a BBA in accounting and an MBA from Bonaventura University. At this time, I'd like to pass it on to Ken Fincher, who will moderate the panel today. Ken?
Thanks, Patty, and good morning, everybody. Before we get started and turn the call over to Jeremy, I want to remind everybody that you can submit your questions throughout these presentations, and we will start the Q&A portion of this call after all 3 of our presenters have presented. So without further ado, I'd like to turn the floor over to Jeremy to start us on this call.
Thank you very much, Ken. I'll start off on the page titled Introduction here. And the first thing I'd like to point out is that City of London has published a document called the Statement on Corporate Governance and Voting Policy for Closed-End Funds since 1999. We're currently on our 9th edition, having updated it most recently in November of 2013. I've been involved in the editing of that document since 2005, and we point to that document as providing legitimacy, transparency, and predictability. And by that we mean that our views are articulated and updated in that document each time it's published. And we make a special effort to make it applicable not just to the U.S., but to other markets. In fact, if you do take the time to look at the document, and it is available on our website, the link is there on that page that you're looking at. On page 17, which is inside the back cover, we contrast the difference in corporate governance in the UK versus the US. And that is a page that, that people often look at and comment on. Moving on to the next slide, board refreshment. I want to focus on a couple of things today. One is the importance of board refreshment. And in our document, and this has been the case for more than 10 years, we specify that three-year terms, which translates in our view to 10 years, is long enough typically for a director to serve. The key component that we're looking at is independence, and independence extends, in our view, beyond the strict legal or regulatory definition. We view that as the minimum standard. We think that it's useful to look at the AIC view from the UK that a presumption of independence is lost after 9 years. And we also would contend that that independence definition extends to service providers. And I'll give one small example there. If a person has served as fund counsel for 20 years, then we don't think that that person's a good candidate to become a director in that same fund. That's the type of test that we're applying to independence, which is beyond the legal standard. As I note, flexible guideline, but there needs to be some turnover. And the objective, at the end of the day, is to provide a mechanism to effect gradual change. Moving on to the next slide, and looking at the issue of plurality voting, we advocate that the voting standard should be majority voting, and as almost everybody knows by now, that standard has been adopted at almost all large U.S. corporations. We would contend that a lot of closed-end fund shareholders who casually vote their proxies probably don't think that just one vote cast for a director in a plurality, where a plurality standard is in effect, would re-elect that director, but that's the case. And we don't see any reason to perpetuate plurality voting. One footnote is that we would advocate that a closed-end fund publish election results after a meeting, as is the custom elsewhere in the world. Moving on to the next slide, proxy access. I really don't have time to go into detail here regarding proxy access, and this is another one of those situations where changes that are being made broadly in large corporations are going to trickle down to the closed-end fund universe. We definitely think that it's an interesting concept. We're the first to say that closed-end funds have different characteristics from open-end funds, and that the primary objection, or at least the first objection that will be raised by fund managers as well as boards, is that the unitary board structure is going to be an impediment to actually allowing proxy access. Our response to that is that open-end funds are one thing and closed-end funds are something else. And so while we may agree from a unitary board standpoint with open-end funds, we would differ when it comes to closed-end funds. And then we get into the questions regarding, so what happens if a director doesn't achieve a majority and is therefore, in the popular vernacular, a zombie? And what we'd say there is let's move towards majority voting, and we'll work through those issues as they arise. So moving on to the next and the last slide, which is labeled success. The first couple of points really define the traits that we would look for in closed-end fund directors. So we want to avoid having to describe situations with words like entitlement, perpetual, and comfortable. And on the other hand, we'd like to look and say that we're seeing expertise, energy, and results being demonstrated. And it really, and this is the last few bullet points, it translates to what are the elements of success when it comes to a closed-end fund. And we want to see engagement in terms of discount management. Obviously, that's a huge difference between a closed-end fund and an open-end fund. When it comes to communication, transparency and appropriate written communications, which can be press releases, can be postings on a website, challenging the manager when it comes to NAV performance, demonstration of true independence, and an awareness of risk management and risk controls and the parameters that need to be controlled. So that's the starting point from the City of London perspective.
Thanks, Jeremy. Our next speaker is going to be Phil Goldstein. And just as a reminder, everyone, please, if you'd like to ask a question, you could submit the questions online, and we will start the Q&A after Daniel gives his presentation. So, Phil?
Thanks, Ken. I just want to say that on Jeremy's presentation, and this could come up in the questioning maybe, I'm not really sure if the majority vote that he's talking about is a majority of the votes cast. I assume it's that, rather than a majority of the outstanding shares, which is a very difficult threshold to...
Absolutely. So I'm talking about the majority of the votes cast, not the 40 Act majority.
Okay. So basically what you're saying is if there's a lot of withhold votes, that should carry the day.
Absolutely.
Okay. And you were talking about an uncontested election, so okay. So let me say that we're probably the most active of the activists by far in the closed-end space, and probably even in all companies, and we're expanded into a couple of other operating companies this year. We've been much more active this year than we've been in the last 4 or 5 years. In the past, past few years, we've tended to settle disputes with management, and frankly, we're not that happy with the settlements we've achieved, because in a lot of cases, while we've gotten a one-time liquidity event, we've been left with a big position, and usually when we settle these cases, these disputes, we have to agree to a standstill, and the standstill leaves us impotent. And if we have a big position, that's not been a happy outcome for us. So we've been more aggressive, and not that we won't settle. I'm always willing to talk to management, but we're not going to settle that cheap. And I think we have to show that that if management doesn't accommodate a good settlement, then we're going to go all the way and run the proxy fight. We're involved in a number of proxy fights, and I just want to, I'm going to add to, people can ask questions about particular ones later, but I agree with probably 80% of what Jeremy said. I think that all of his points, and the City of London's points, are designed to be proxies for really getting directors and management that as this program is talking about, put shareholders first. I don't think it really does the job, because at the end of the day, what you're really doing is having box checking, when what it really comes down to is what's the mindset and the philosophy of the actual person who's in charge. And I'm going to now say where I think some good like for example, we have had discussions in the past with Nuveen. I think that they are responsive to shareholders. I think that they deal fairly with them. Without giving any secrets, we've we've had discussions with other management groups that have dealt fairly. Doesn't mean you always agree on things and you can reach an impasse, but at least you deal fairly. Right now, we're engaged, as some of the folks may know, on the line with a proxy fight with a fund, LMP, Real Estate Income Fund, run by Legg Mason. And I must say that Legg Mason, I don't care if they meet all of Jeremy's requirements, but they have cheated, played dirty, and we're seriously contemplating suing them. We're also going to sue a small BDC, probably today, which is symbol BDCV. Again, playing dirty, cheating. We're willing to lose fair and square at the annual meeting, but we are not going to tolerate breaches of fiduciary duty. And I think you need both the type of formal reforms that Jeremy is doing, but I've seen plenty of codes of ethics, and they're just words on a piece of paper. And unfortunately, when people have asked me in the past, well, can the director do this? Can the director do that? In the case of LMP, they adjourned the meeting because they would have lost, and they're looking for more votes. And my answer to that question is the board of directors can do anything they want until the judge tells them they can't. And that's the sad truth. And we have to. So in addition to more proxy fights, so I think we're going to be seeing more litigation. And again, Legg Mason has shown a despicable contempt for shareholders. I don't mind saying it on this call. I hope they're listening. So, to the people, to Jeremy, and who's a nice guy, as is Barry Olaf, and they got the best of intentions. I feel like Connie at the end of The Godfather 1 when talking about Michael, and she says, read the papers, there's your husband. And I see it. You got to get down and actually see what they do before you know who's really acting in the interest of shareholders and who's not. So that's the end of my remarks.
Thanks, Phil. Again, a reminder, everyone, if you would like to...
By the way, Ken Fincher, I want to say, put in a plug for Ken's organization, is one of the good guys. We don't always agree, but they've always been upfront, fair, and not pulled anything dirty.
Thank you, Phil. Just a reminder, if you'd like to submit a question, please do so. We're going to turn the microphone over to Daniel Lippincott from Carpus. So, Daniel, your comments, please.
Thank you, Ken. So this is my first webinar, and I've already learned you don't want to follow Phil Goldstein on the panel. But I can agree with Phil that Nuveen has been great to work with. We've worked with them in the past. We don't always agree. In fact, we rarely ever agree. But they're very professional. I didn't want to really name any names, but we've had we had a recent contest with Alliance Bernstein on one of their taxable fixed income funds, and they played incredibly dirty as well. They didn't allow our directors that we nominated to be up. They wouldn't recognize them in a meeting, and then they actually petitioned the SEC for a no action letter that would allow them to exclude our proposal at the annual meeting. So there's a great dispersion between really good fund companies and boards and really tough, almost dirty boards, I would say. But I'll give you a little bit of information about Carpus. We're an RIA founded in 1986 by George Carpus, located in Rochester, New York. Manage accounts for high net worth individuals and institutional accounts. The common theme is closed-end funds. We believe they offer really uncommon value when they trade at a discount, as well as there's a tremendous level of diversification. Our beliefs as far as activism, As I said, we believe closed-end funds trading at wide discounts are an optimal investment vehicle. In a perfect world, we would buy a closed-end fund trading at a wide discount, hold it as it experienced tremendous net asset value performance, and the discount narrowed over time. However, we all know that doesn't always happen. We rarely vote with our feet. We'll do the best in a fair way of what we can to unlock value for shareholders, working with management or actually going all the way in a proxy contest. We don't target funds for activism, but obviously it's necessary when there is poor performance, persistently wide discount, or if there's a catalyst such as the triggering of a lifeboat provision. If they sell the management contract, in that case, the fund company selling it wins. The fund company buying it hopefully has some synergies and they win. What's left is shareholders with funds trading at a wide discount stuck in that fund. So we use that opportunity if that does arise to enhance value for shareholders. We're also opposed to any fundamental investment policy changes, especially ones that just really don't make any sense and that could possibly cause us to sell. We have investment policy statements on a lot of our accounts. So if a fund wanted to go into more, say more high yield, and we weren't allowed to hold that in the account, we'd have to sell that, and that could potentially widen the discount and harm other shareholders. The current environment, we've been more active, not quite as active as Phil, but we've been more active recently, mostly since the discounts on fixed income closed-end funds widened in 2013. Really, if you look at the equity funds, they seem to be pretty complacent. Discounts have been pretty stagnant over the last, say, 3-4 years, and performance has been positive. So we've seen it's been hard to get any traction with those shareholders there. Although the net asset value performance in general has been fairly poor on those funds. But fixed income investors have gone through quite a bit of pain with, in 2013 with the taper tantrum, you had the underlying net asset value getting hit and the discount on the closed-end fund widening. So they were, a little more receptive to any kind of changes or any kind of way to enhance value that was brought to the table. Obviously the potential for activism increases with wider discounts. That's really the way it's going to be. If you look at the time period from, say, 2010 to 2013, we really didn't engage in much activism at all, just because discounts were narrowing over that time period. There was really no reason to do it. So right now, in this environment with fixed income discounts trading at this level, we believe there's going to be tremendous opportunities if boards do not act if they don't do the right thing to take steps to narrow the discount. We actually have a couple proposals out there right now that should be included in management's proxies this year. So that's the end of my remarks, Ken.
Thanks, Dan. And we're going to open up to the Q&A. And I want to pose the first question because each of our panelists touched on this discount management. Dan, of course, you went into a little bit more with 2013 in the fixed income markets. And this can go out to all three of you, and I'd appreciate your response. When you look at discounts, are you looking at NAV performance relative to some kind of benchmark? So, for example, if a manager is out there and they're, let's just say in fixed income, on a relative basis, we've seen here in the last couple of weeks people get a little bit nervous about higher rates. If the manager on a relative basis has outperformed, yet his discount has widened, is that a fund that you may target because that discount widened because maybe retail has headed for the exits?
Is that to me, Ken? This is Dan.
It could be to any one of you.
Okay. Generally, that doesn't happen. I mean, you'll usually see. I mean, it can happen for a short period of time, but over long periods of time, if a fund performs well, it has a good distribution policy. That fund doesn't stay wide for very long. We usually see the NAVs doing poorly, discounts widening, maybe a cut in the yield, and that's when that's an optimal target for us at that point.
Jeremy, Phil, any comments on that?
I think I agree with Dan. I think the idea of a temporary widening that's not going to cause a problem for a fund. The problem generally occurs, and the activists become active when there's a persistent discount, and management doesn't do anything about it for a long period of time. So it's usually the problem festers, but you know, look, we've all seen discounts widen dramatically for short periods, like especially in '08, you know, when it was crazy. But you didn't see activism because they quickly popped back to a more reasonable discount. So it's really when the problem is there for a long time. After all, it takes time for an activist, for anybody, to accumulate enough of a stake to become active. So, I mean, first you have to have a wide enough discount that the activist is going to be attracted to it to try to accumulate a stake, and that could take a long time. It could take 6 months, a year, or more to get enough of a stake to make it worthwhile to push management. So this is not something that's going to happen over a brief period of time. As far as the performance, obviously, if the fund's had a good long-term performance, that's going to be a good factor, even if the discount, you know, is temporarily wide. So I think that answers the question. I just want to comment on one thing that Dan said, which I don't focus on as much, but he's absolutely right. And you mentioned it in passing, but it's about changing the objective of the fund. I mean, talk about putting shareholders first. I don't think a board should ever change the objective of a fund in any way, whether they're allowed to or not, without putting it to a shareholder vote. I don't understand how that's justified. I'd like somebody to tell me why I'm wrong. I mean, legally they may be able to do it, but it just doesn't seem right.
Jeremy, any comments on our first question?
Yeah. And first of all, I agree with Phil. We would also say that whether a fundamental investment policy or some other investment policy can be changed or not without a shareholder vote, the shareholders should be asked. When it comes to the way that we look at discounts, we're an institutional firm. We focus on emerging markets funds to a large extent, but not exclusively. Our clients measure our performance relative to a benchmark. We have a disciplined internal research team that looks at the closed-end funds, and we absolutely evaluate NAV performance relative to the benchmark, to the appropriate benchmark of that fund. And we'll certainly engage in discussions with the board if we don't think that the benchmark is appropriate. And then on the discount side, completely agree with the comment that Phil made. It's the persistent discount that's the problem. So discount volatility, quite honestly, is a good thing. It's kind of why we're investing in closed-end funds, and I think that's true to a large extent of probably everybody. But a discount that is ignored and becomes persistent is a problem. And over a long period of time, it can even make that product no longer viable in the marketplace.
Okay, Phil, our first question comes to you, and the question is, should investor activism be more of a mainstream solution rather than a reactive fight for the best corporate governance for all industries?
Should it be more of a mainstream solution? Yeah, it should be, but the problem, it's not easy to be an activist because you need to have the capital to do it, and you can be sort of a shoestring activist by submitting a 14A8 proposal, but that you're not going to be able to really be that effective, you know, until you can actually run a proxy fight and threaten to get on the board, because there's a big difference between being an outsider and an insider. You know, to be on the board and be complaining about the board. So. Yeah, I mean, the answer is it would be great, but it's just, you know, under the current system where you have to fund your own proxy fights, and I don't see it happening.
Okay, the next question that comes in, and Phil, it comes back to you again. And this is, how do you think about managing the discount on SPE? SPE is, of course, Phil, the closed-end fund that one of your organizations runs, relative to the discounts you see on potential investment targets?
Well, we have a share buyback program, which we announced before we were at a double-digit discount. The discount's about a little over 11%. I'm not going to comment on what we're doing, but be assured I'm aware of it. The problem is with SPE is it's a very thinly traded stock. It's trading like, sometimes under 10,000 shares a day. So there's only so much we can do. I mean, we could get rid of the discount in a couple of days if I just said, go in and place market orders. But that said, we have very sophisticated shareholders that own a significant portion of the fund. If any of them want more done, we're happy to do it. I don't want to be accused of hypocrisy. I'm willing to shrink the size of the fund if that's what people want, but I think I take pride in what I believe is the fact that most of the people who have purchased our shares of our fund purchase it because that we're doing some unique things in managing the money, and they're not as focused on the discount as shareholders of plain vanilla funds that are, kind of interchangeable, or there's ETFs that can duplicate it. So,
Phil, how do you market that? Because you basically say we're not as concerned about the discount, yet everyone else
I didn't say we're not as concerned. I said that the shareholders are not as concerned.
So how do you market you're doing something so different in a closed-end fund wrapper than everybody else?
Well, that's why I'm on this call and none of the other closed-end, because we're using activism as a primary investment strategy. And actually, closed-end funds are an excellent vehicle for that because it's more difficult when you have to make redemptions if you're in the middle of a proxy contest and you would have to make redemptions. That could really hurt activism. So I think people value what we bring to the table more so than the vast majority of closed-end funds, which are just, I call them like plain vanilla.
Okay, Jeremy.
But
question.
Look, we have one shareholder that owns like 25% of the shares. If they come to us and tell us, look, we want something more aggressive done, you can be sure we're going to do it.
Okay. Jeremy, question for you from your presentation. You mentioned on your first slide that the applicable in the U.S. and other markets, your statement of corporate governance. Does the City of London take the same stance in the UK, again, you mentioned the United Kingdom, that you do in the US in regards to the closed-end funds that trade in the UK? Because there are persistent discounts in UK funds as well.
Yeah, so absolutely. And, it's really interesting for me to sit here and listen to this because there's plenty of room in the world for different approaches. And so we would describe ourselves as not being activist because we stick around in the same sector, so primarily focused on emerging markets, closed-end funds. But certainly there are boards out there who have encountered us when we have become active, right? So we sort of draw the distinction between active and activist. And we have that same approach not only in the UK, where we think that by and large the standards for corporate governance are a little better. In other words, we think there's actually a little bit more shareholder democracy in London than there is in the U.S. And we're currently involved in a fund in Hong Kong. So this is we have 4 offices around the world, and we are involved in closed-end funds with the same kind of approach, which is long-term investor, but we're not here to be pushed around. We will push back if we have to, and that's global.
Jeremy, you bring up a good point that I'd like the other couple of panelists to respond to. For Dan and for Phil, do you get involved with closed-end funds, whether it's through your separately managed accounts or Phil through your closed-end fund that you have that lists and trades, with the intent? Do you get involved? Do you make investments in other closed-end funds with the intent of being a short-term activist shareholder. I've heard it in my years in the industry many times that, you know, hey, these guys are not for the long term of the fund. They're here. They're short timers. They're just trying to make change, and they see an opportunity. Are you long-term investors, or are you short-term opportunists?
You want me to go first, Dan? Or?
Sure.
Yeah, go
sure.
ahead, Phil. Yeah.
I only wish that I could get short-term returns. You know, like I'd love to do that. I don't think there's unfortunately, that it just doesn't work like that. But you know, let me answer that with a question. Let's say you bought a stock because you liked the long-term outlook on the stock, and the stock was trading for $20, and the next day somebody comes in and says, you know, makes a takeover bid at $40. Are you going to say, darn it, I wanted to hold this for a long term? You know, I mean, so there's nothing wrong with a short-term return. It just doesn't work like that. As far as the question of whether you target it, I think what we do is we look for value. I suspect Dan is the same, and as is Jeremy. We look for value when we make the initial purchase, but we know that we keep in our toolkit activism. I mean, if the discount narrows on its own, that's fine, and then we'll sell. I think that's kind of what a City of London might do, you know, and you know, I call that regression to the mean. But if it doesn't, you know, and it's persistent, and management's not addressing it, then we'll be active. But we don't go in immediately and say we're going to be active. We have that in reserve.
Dan?
Yeah, I guess if you look at it's really the exact same thing for us. You know, like a good example of that is if you look at 2008, we bought a ton of closed-end funds at, you know, 20, 25, 30% discounts. You know, we just found incredible value there. You know, we held them really, especially if you look at fixed income funds, held them through pretty much to 2011. So I mean, that's 3 years. That's pretty much a long-term shareholder at that point, and exited the position. I mean, we weren't looking to, you know, the funds traded at 20, 25% discounts. Over the next 3 years, they went to net asset value. We're not big proponents of paying more than $1 worth. You know, we're not big proponents of paying more than $1 for $1 worth of assets. So if they become fairly valued or even overvalued, we exit the position. There's just no more value there. So really, exactly what Phil said.
Okay. Our next question from our audience is for Dan and for Phil. Can you comment on the role of changes at the management company, management ownership, in selecting potential target investments? I mean, I think you guys have gone on record a few times saying, I like working with these people, I don't like working with those people. Are there targets that you have? I mean, do you go after the firms that you think, well, you know, I'm going to have a fight with?
Well, go ahead, Dan. You want to?
Not really. I mean, as I said, it's really a function of discount. You don't really know. You don't really know going into it. You know, we don't target Nuveen funds because they work with shareholders. That's not something we do. You know, we'll go for if the fund is trading at a wide discount, a persistently wide discount, has poor performance. Really, we don't really take into account that much. Really, the management company, but we will look at the shareholder base around it. So if you have, there are some funds where there is there's a very fund-friendly shareholder or somebody who's known not to really go along with an active stance, and may avoid those funds just because the probability of winning or having any influence is low. So we'll avoid it if there's the chances of winning are low just because of other shareholders. But we don't really we don't check off any fund company saying, you know, we're not gonna buy that fund because we don't want to be active against them.
Well, it's certainly a factor. I mean, there are certain ones that are so bad that it just wouldn't be worth it. Like the RMR fund. I mean, we were involved in a fight with them years ago. They wound up suing us. They wound up spending 5% of the NAV on suing us, and we had to settle because we realized that even if we won at the end of the day, they were going to, hit the NAV was going to be hit for someone. They didn't care, basically. Talk about the opposite of putting shareholders first. I mean, they were just spending so much money on lawyers that we would, even if we won, it would have been a Pyrrhic victory. So there are some people that are horrible. People have come to me and said, "Well, did you ever look at Foxby?" And I wouldn't touch it. Maybe, I mean, look, everything's got a price, but I think the discount would probably have to be 50, 60%, because some people are just going to burn up so much money. But whereas if you get to the people who actually do have some, concern about their reputation, and I put Ken, your firms in that category, the New Beans, and there's plenty others, Morgan Stanley, that they care, they have a reputation, and they're not just going to throw away all the shareholder money just to fight off an activist. There are some that I would stay away from. It's just not worth it. Life's too short.
Okay. Jeremy, the next question comes in related to conversation you and I just had a moment ago. It says, if corporate governance is better in the UK, why are discounts wider than the U.S. for City of London?
Well, I'm not sure that that's entirely true, right? So now I'm in the corporate governance part of the investment management team, but I'm looking at one of my colleagues who works on the investment management side. And every week I sit in meetings where we have discussions with our colleagues in Singapore, Dubai, and London. And I would say certainly at a high level that statement just isn't true. And part of the reason that we've managed to be a successful business over an extended period of time, sticking with this particular sector of the marketplace, is that sometimes the discounts in London are wider than the discounts in the U.S., but other times it's just absolutely not true. And certainly if you then take a step below that and look at either a regional or even country-specific, on a country-specific basis, it's absolutely not true. So I really don't think that it's a true statement, although I'm happy if somebody wants to give me some more facts.
Okay. Next question is, what benchmark do activists and their shareholders use as a measure of performance? So Jeremy, I'll start with you.
So what benchmark do we use as a measure of performance? We, as I said before, we are long-term institutional investment managers. I don't know if everybody's getting that feedback, but I'm getting feedback.
I'm getting, some feedback as well.
I don't know whether somebody else can mute, maybe. But anyway, City of London is an institutional, long-term investment manager. Our clients measure us relative to the benchmark, and so we look at...
What is that benchmark? That's the question.
Well, broadly, it's generally speaking MXEF, right? So the Morgan Stanley Emerging Markets Benchmark, but on a fund-by-fund basis, it is the first thing we look at is the benchmark that is stated in the annual report, right? So if it's a China fund, it's going to be the appropriate benchmark.
So you'll use an appropriate benchmark that basically the fund company has stated in their prospectus or in their annual report.
Yeah, and we'll certainly challenge it, right? So if it's not a total return benchmark, that's a problem.
Phil, what benchmark do you use?
Well, it varies depending on the fund, but I prefer not to use a benchmark because I feel that we're really kind of a total return fund, and based on risk and reward. So depending on where the opportunities are, we're willing to go, very heavily in fixed income if that's where we think the opportunities are versus or equities if that's what's cheap. But I will say that for our largest hedge funds, we use both the S&P 500 and we use a 60-40 hybrid index, which is 60% S&P 500, 40% Barclays aggregate bond index, which we think is that, if you're going to use one, that's what we use. But really, we're kind of total return.
But how do you compare, Phil, the funds that you invest in, how do you compare their performance? What benchmark will you use, let's say, for an equity-based U.S. domiciled closed-end fund?
Well, we accept whatever they use. I mean, we don't
Okay.
set the benchmark.
Okay,
So yeah.
Okay.
Let them accept. I always sort of said, well, let's use the benchmark. Whichever one we beat, let's use that one. We'll call it the chameleon fund.
There you go. Dan?
If we're looking at a fund company, or
Yes.
if we're comparing a fund, yeah, we'll use exactly what they use. The problem there sometimes is they'll use two different benchmarks. So when there's two bogeys, really, what are you going against? But we'll in that case we'll use whatever we think is most fair. But yeah, we use whatever they use.
Okay. I'm going to start this one off with Phil. How do the speakers define persistent and large discounts? 1 year, 5 years? What's the time frame? What is your definition of persistent and large discounts?
That's like what the Supreme Court said about pornography. I know it when I see it. I mean, 5 years is way too long. I would say if you're trading, just give you. I think I think double digit is kind of a magic number. I think if, as an example, let's say it's a plain vanilla bond fund, or let's say it's a municipal bond fund. I think a 12% discount for a year would do it. So I don't think you can put an exact number on it.
Okay.
But that kind of feels right. Let's see
Dan?
what Dan says.
I agree with Phil. You get in that 10 to 12 range. It's kind of the magic number for the discount being considered wide. That's when we really get interested in buying the fund.
But what time frame do you look at as well, Dan?
If you're talking about before it's a problem.
Well,
So
before
I
you
would
say
probably,
it's persistent discount. I mean, are you saying in 1 year like Phil says, or are you saying hey, it's 3 years, it's 5 years, it's some other time frame?
I'd say between 2 and 3 years, but it also depends. I mean, it's a lot of factors go into it. But if you're just looking at the discount, yeah, it's persistent in that probably around 2 years, I would say.
Jeremy?
Yeah, I think we're sort of thinking along the same lines. So what we see as a typical investment cycle is 3 to 5 years.
Mm-hmm.
And we look at the discounts, not even just daily, but constantly throughout the day. From a corporate governance standpoint, if a portfolio manager comes to me and says, this fund's discount has been wider than the average, in other words, looking back over 3 to 5 years, for the last 12 months, then I think every alarm bell that we have would probably go off. Now, that doesn't mean that we're going to immediately, as Phil alluded to earlier, fire off a 14A8 shareholder proposal. But it does mean that we're going to do some serious work that could get to the point where we're actually having a conversation. And one thing that I would point out, and I think this is actually very significant, at that point, we don't believe the conversation should be with the investment manager, because the investment manager is responsible for the NAV performance. We think the board of directors needs to be engaged enough so that if they've had a discount that's wider than average for 12 months, the board can respond to us.
Okay. The title of this webinar is Putting Shareholders First, and this goes back to maybe a question I asked earlier. But a lot of folks on the other side of the aisle have always thought that many of the firms like Bulldog or Carpus or City of London are out there, are you putting your shareholders first or the shareholders of the fund first when you go and look at a fund for possible action? Because a lot of the results have been small buybacks or tenders that don't satisfy everybody. And Phil, you sort of alluded to it earlier in terms of how active you're getting in 2015.
Well, obviously we're putting our shareholders first. I mean, look, we put our own shareholders first, whether an SPE or our investors who invest in our hedge funds first. That's what we're looking to achieve. If the interests of our shareholders are aligned with a sufficient number of the shareholders of the closed-end fund we're targeting, then that's fine. We're going to win. If they're not, then we're not. So, one of the things you haven't asked about, I mean, it's kind of, a slap in the face with reality. I mean, we could talk about discounts and what's persistent, this and that, but, if we, as Dan sort of said, if we feel we can't win, if the shareholder base is such that it's heavily retail and they don't even know what a discount is, they don't even know what they own, we're probably not going to be very successful. So when we look at a closed-end fund, even if it's trading at a relatively modest discount, let's say 9 or 10%, but we see 35% owned by 4 or 5 shareholders, I mean, that looks like an attractive target to us because, maybe it doesn't seem right because you say, well, you got all these retail investors and they're kind of complacent, but that's the reality. We look at the discount plus the shareholder base. And if the shareholder base is aligned with our interests, then we think there's an interesting opportunity.
Jeremy, Dan, you care to comment?
Yeah, I'd
Sure.
be happy to. You want to go ahead, Dan?
Yeah, we as an RIA, we have a fiduciary duty to look out for our clients first. But generally, I would say that, our actions do keep, the overall discounts in the closed-end fund space more narrow. As Phil mentioned, there are funds where you could buy 20% of the outstanding and you probably still couldn't win. Those funds, there's a pretty big discount for lack of control. I mean, they tend to trade a lot wider. In some cases, anywhere from 5 to 10% wider. When you have, there's no potential shot for activism, and the fund management controls the fund. Those generally trade a lot wider.
Okay.
Yeah,
Jeremy?
a good example would be like Central Securities.
I don't want to name any names, Phil, but there's a couple.
No, but it's just an example of where
you're
going to just be beating your head against the wall.
Exactly. Yep.
Yep. Our view is that if I'm a retail shareholder and I've enjoyed below benchmark NAV performance for an extended period of time, and I'm looking at my shares and I'd get 85 or 90 cents on the dollar relative to the NAV, and there's an ETF alternative in that same sector, again, we're emerging markets closed-end funds, then how in the world aren't all of our interests aligned?
Okay. Just a reminder, everybody, if you have a question, please feel free to submit your question. The next question is discount management tools. We've sort of all talked about that. Dan, what works and what doesn't work?
I guess there's proactive measures that a fund company can take.
Give me some examples.
If they buy back shares in the open market, I mean that's accretive to net asset value, which improves the overall performance of the fund.
Well, that helps NAV, but does that really discount management? Doesn't that widen the discount out technically if the NAV performance improves?
It hasn't shown to, but it should. If you have good NAV performance, the discount of the fund should generally trade more narrow over time. So that's a proactive step you can take. Obviously, that doesn't satisfy, the likes of the people on this call, most likely.
Mm-hmm.
But I think if you could look at the other end of the spectrum, open ending or liquidation, that's, really you only see that when if the base, if activist shareholders own a tremendous amount of the outstanding shares, maybe 40-45% of the outstanding. There's really no shot of a proxy contest for management being successful. They decide they don't want to waste money. They want to do the responsible thing. They'll liquidate or merge it in with an existing open-end fund. That's really the right thing to do instead of wasting the money. I guess the kind of middle ground is a tender offer, which is generally agreed upon by, I guess you could say the board, but management and the activist shareholder, they come to an amount and a level of NAV that they want to tender for. That kind of, the disgruntled shareholders get out at or near net asset value.
But you don't all get out because typically it's only X percent, right? So you submit along with everybody else to get a partial redemption, correct?
Yep.
Or are you put above the head of the pack?
No, it's pro rata. If they put up 50% and it's a tender offer for 50%, everybody gets out. If they were doing 100%, then you'd only get half your shares. So
has Carpus done any? I apologize for interrupting you, but has Carpus done any studies after a tender offer to see does performance improve for those people who are still there, or are they sort of left holding that proverbial bag?
You'll see, in anticipation of the tender offer, the discount will narrow and then it'll widen back out. I think if you look long term, if a fund is trading at a persistently wide discount, there's obviously an imbalance between the supply and demand. There's too many shares out there, and there's not enough demand for those shares, so that's why it's trading at a discount. A tender offer kind of cleans up. If you get the optimal amount, will clean up some of that overhanging supply, and should, in theory, I haven't done any studies, but it's in theory, if there's less supply and same demand, the discount should narrow.
Okay, Jeremy, what other discount management tools do you think that work out there?
Yeah, what I would add is to Dan's list. So I agree with Dan's list, but we advocate that a stated target for a buyback actually is effective, and there
Give
are
us an example.
Well, Korea funds. If you look at the emerging markets closed-end fund sector, there are two Korea funds. One has an active buyback and with a stated objective, and one doesn't. And currently, I'm looking at my colleague, but I think the discount range is 4%. I thought it was 5% between the two currently. So there's a real live example that's current. That's the two funds are pretty much interchangeable. The investment performance from an NAV standpoint isn't very much different. One has a buyback with the stated target, and the discount is currently 4% narrower than the other. And
how is performance? How is the discount's one thing? How is performance between the two?
Both
is the one that has the buyback does it have better performance, or is it?
No, the NAV performance. The NAV performance and the price performance for both are in line.
They're in line.
So if you look at that fund, they're buying shares back at a 5% discount. That's really not probably the best use of the fund's capital at that point. That's why. But if you're looking at a fund that's buying shares back at a 15% discount, that's almost if they buy 10% back at a 15% discount, that's incredibly accretive. You're looking at just south of 2%. So I think the responsible thing to do is buy it when the discount is widest, and then don't buy shares back when the discount's in that 3, 4, 5 level. That's where you don't get the most bang for your buck.
Okay, Jeremy, anything else?
No, I'm good.
Let's switch gears here a little bit. Obviously, in the closed-end fund space, sponsors have had a nice run since 2009 through 2000 and let's call it 13 with the IPO process and more funds coming to market. Phil, give me sort of your thoughts on the IPO process, either the way it stands now, or do you think more IPOs are needed in the closed-end fund space? Do you think more funds are needed out there?
Yeah, we need more funds.
Sarcasm, Phil?
A little bit. Look, the truth is, closed-end funds are probably one of the only securities that get virtually no professional investors to invest in the IPO, because the odds are very, very high that they're going to be able to buy it at a discount in the secondary market. So it's virtually always a retail product. What happens? I mean, there's a kind of a life cycle to these, and they come out at a premium to NAV because of the underwriting fees, and because they're sold. The retail investors are sold a bill of goods, and then eventually they go to a discount. Maybe it's even a wider discount. They sell out, and then the people like myself and our fellow panelists start accumulating it when the discount gets wide enough to become attractive, and then there becomes some pressure on management to do something about the discount. And if we're effective, we can get rid of the discount, and sometimes get rid of the fund, and then go out and issue another fund. So it's kind of like, if you look at it, it's kind of like the cycle is that the poor retail investor is getting screwed, and the professional investor is making money, and then the manager's making money by issuing new product, and that's the way it is.
Okay. Jeremy, any comments on that?
No, I don't have any comment.
Okay. Jeremy, you talked earlier, I want to go back to your presentation about the boards. You talked about plurality versus majority. Have a lot of boards been receptive to some of the changes that City of London has suggested?
Yeah, almost invariably, the first response we get is that the status quo is just fine. But we have been successful in a couple of instances where we've been able to convince a board that adopting the majority standard is something that makes sense and can be done. And we're actively working on that sort of behind the scenes currently. And it's sort of almost it's an ongoing project that doesn't have a tremendous amount of visibility, and we're very patient. We've been talking about this for a couple of years, following along, as I said earlier, with what's been going on with Fortune 500 companies, and we're going to be persistent, and we're going to look for opportunities where we can use that as a negotiating point.
Okay. Gentlemen, we have exhausted the number of questions that have come in from our audience, but I have one question sort of before we leave. If you had any advice you could give to a retail investor who wants to or who is currently involved in closed-end funds outside of investing with you, what would be that advice? And Dan, I'll start with you, then we'll go to Phil, and we'll finish it up with Jeremy.
Don't chase yield. Really, you got to look at the total return aspects of the fund is going to be, you want to buy the fund at a wide discount, both on an absolute basis relative to its peers and on historic to itself. So you want to make sure the fund's trading cheaply. You don't just want to buy a fund because it has a 8, 9, 10% yield on it. And you want to look into what the components of that yield are. And if you can, look on the SEC filings, check out who the other investors are in the fund. Just to make sure you're not getting into one of those funds where where management controls the fund and there's really no motivation for the discount to ever narrow. It's just really do your homework. Don't just buy blindly on yield or a recommendation from your broker or because somebody writes it in Seeking Alpha. Really, dig into it and really know what you're buying.
Phil?
That's great advice. I really can't think. That's great advice, Dan. Can't top it. The only thing it just brings to mind a quote I think that Tom Hersfeld once wrote in one of his reports that there's a difference between return on capital and return of capital.
Yes. Mm-hmm. And Jeremy?
I would limit my comments to equity-focused closed-end funds. And I would say in that context, it's the quality of the investment manager. Take a look at how institutional investors proceed, and their consultants, and really understand the quality of the investment management team that's on the job. And I think that what you'll find is over the long run, it's really not the discount, it's the net asset value performance that is going to cause a fund to be successful in the long run.
Thank you for those comments, gentlemen. I'd like to thank each of you for your time today for this call. As Patty mentioned earlier, a replay will be available on the cefnetwork.com website under events, hopefully in short order. Thank you, everybody, for listening in. This concludes our call, and thank you again for our panelists.
Thanks, Ken.
Thank you.
Thank you.